I specifically decided to speak before Saurabh because Saurabh will show a lot of stuff which is very impressive and better to present before the impressive guy speaks. Uh, I decided that I would speak from a different perspective as an investor in more commonsensical stuff because I don't think markets are as complicated as made out to be. I think the way markets have to be evaluated is that it is a question of demand and supply. If demand is more than supply, markets go up. If supply is more than demand, markets come down. And various factors determine whether they go up or down. Saurabh will cover all those factors in detail. But having been in these markets for a long time, one gets some sort of perspective very easily from charts. So that's why I would like to put some story behind the charts. Very early in my career, I was told that the every year, if you look at the market from 1 year perspective, it's mainly about sentiments. If it is looked at from a 3 year perspective, fundamentals come into play. So when we talk on all these presentations, it's generally on a 1 year perspective, and we try to predict sentiments. The other thing is, I think markets uh, follow patterns linked to behavior and linked to fundamentals which are cyclical. So every economy goes up, every economy goes down, and that then gets reflected in the market. So maybe the past gives us some idea of trends, and that is what I try to present a little bit. So this is the chart of BS Nifty 50, which is the main index on the market. As can be seen from this chart, between 2021 and 2022, markets had a really sharp rally. And then it consolidated for about an year. Same way, if you see from 2023 mid to 2024, markets have had an equally sharp rally. And this represents cycles of the economy. So if one sees this without too much thinking, one would possibly say that the markets have a year of correction, of consolidation, sorry, wherein it is in a tight range. And if you put a meaning to this, then a lot of people have been talking of markets getting overvalued, economies slowing down, and all that, as it catches up, will lead to consolidation. So in most of our discussions, we will possibly say that the next year will be a challenging year because it is a year of consolidation after a good rally. There could be declines, but maybe as the markets consolidate and go into a year, the valuations will catch up and the economy will break out again into the next cycle. So broadly, if one sees the Nifty 50 index, we think this is the view. This is the BSE Sensex. It is also showing exactly similar trends. A rally with consolidation, another rally, and a consolidation. Then I do want to show the Nifty small cap index because one of the characteristics of the Indian market is there's a lot of retail money coming in. A lot of the money is going into SIPs, mainly in the small cap and the mid cap segment. And then this chart gives you a trend again in the same period that I showed you when the markets consolidated. In that same period, the markets had a very strong rally. And then the small cap showed a 40% fall. Same way, the markets have rallied almost exactly similarly now. And so if one was to predict the future, what should be the possible fall from the peak? And if one was to just see this and hazard a guess, one could say 40%. So there is this opportunity that the markets will give on a correction. After the correction, obviously there's a consolidation and a sharp rally again. So if one was to see this small cap where retail is, one would expect a 40% kind of correction from the peak. 20% or so has already happened, little more now, and then a sharp rally. I do want to talk on one of the indices which I think will guide the markets in the coming year, which is the S&P 500, which is the US index. What has happened in the past is, and the way to read it is, there are three large global economies. They are US, India, and China. And over the next, say, 20 years, it is said that these three economies will still be the world's largest. The rankings may be China first, US next, and then India. And obviously, each of these economies move in their own cycles, and it is possible that the Indian economy ran a cycle, and one knows that Atmanirbhar Bharat and whatever the BJP was doing was building expectations in the market, which is now consolidating. And if you remember the previous chart, the rallies in both, so I'm going back to the previous chart of the index, the rallies in both these periods were same. So in a way, markets have gone ahead of valuation. Now, if one sees the US markets, which is the S&P 500, in its previous rally, it's given 140%. Current rally, it's given 65%. So clearly, if US says that they want to make America great again, then there is still a leg of the rally left. So that is why most people say that while US is still overvalued, the Trump effect will create continuation of the rally, though there will be volatilities. Today is an example because when US does well, the other markets follow. But if you see the charts, it's a 50-50 chance. Bias is upside and is positive. Important because this one creates good sentiment. This also explains why money is going back into the US. That is why FIs are taking out money from the country, because the home market of all the money is showing a strong rally which can continue for a year. There's a lot of talk on the broader market rallying in the US. And if you see the Russell 2000 index, which it has given 110% return a long time back, and then it has been flat for a long time. So if one was to evaluate this blindly and one thinks that India will replicate in the US where the small cap rallied, then the small cap there will also rally and will double, I would think, in the next year or so. So broadly, therefore, US markets look to be decently positive. Indian markets consolidation, small cap correction is what is coming out as a thought process that one sees. Tech is important, which is NASDAQ. And you can clearly see why it will correct, because the rally there is similar. It has rallied to its peak. And from here on, it will determine whether AI can give the performance. Hence, NASDAQ is in an area of risk. FANG, which is the other rally, has really gone 250% plus return, super high risk. Smart strategies are needed. Now, the reason I again want to highlight this is a lot of these strategies get replicated into India. People chase the tech stocks, people chase the FANG indices, and hence I thought it makes interesting perspectives to show both these rallies. Gold has behaved very contra and has rallied sharply. There is a view that because of overvaluation, because of volatility, gold may be attractive, and there are two levels, 2,400 and 2,200, but 2,400 may be a good level to invest because of overvalued markets. Finally, coming to Indian markets, if you correlate everything, you see that, and I've taken the peak of the Indian market sometime in September 24, and I've taken the market level maybe a couple of days back, 8th Jan 25, sometime back, so a week back. If you see the index fund on Nifty, on 27th September, it was a 34% return, which was 1 year. On 8th Jan, it was 10%. The 10-year returns are 11 to 12%. So clearly, the index at the broader level is decent. Large cap funds were 28 to 32% in September. Now it is 15 to 16%. 10-year returns are 12 to 14%. Therefore, you see a lot of people saying large cap funds are attractively poised for investment even now, though a small correction is expected. Mid cap, small cap have behaved similarly, 45 to 62% return in September. Now they have corrected 20 to 21. The long-term returns are 15 to 21%. And a little bit of more correction to get the 1 year average to 16 to 20 and then a rally. So to that extent, mid cap, small caps are becoming attractive, though some way away. Gold is decent, US is decent, thematic funds are corrected heavily. And when the correction uh, uh, gets over, it is interesting to invest. We are happy with this correction because while the markets had retail flows, it is good that they've responded to fundamentals, overvaluations, and uncertainty, which is a good sign for India. Little bit more correction due. Debt funds have given good returns because the interest rates are high. We believe long-term averages require more correction. When to enter is important in line with profile and length of holding period. But whether you invest now or whether you invest 10% down, they're attractive levels. Staggered investing is what one would recommend. Overall, if you saw those graphs, at least in India, current year 25 will be tough. The markets are overvalued. Fiscal spending is increasing. Higher inflation is possibly a way forward, and there is global protectionism. In terms of strategies, we have to be clear that what is happening in India vis-a-vis its GDP is that it may be one of the global economies which will show exploding growth long term, though the world currently is in a short market cycle world, which means there will be opportunities to invest. Clearly, a lot of the investing has gone to new age opportunities, which is why large caps are not seeing interest. There was an article recently which said that FIs are selling old stocks and investing in new stocks. By and large, Indian retail, by investing in IPOs, is following this. So to that extent, new age opportunity hunting, I think, is important in these markets. In a high inflation environment for the next couple of years, equities will be a key asset class to get returns, though after those corrections. And large caps are already very attractive in India, though the waiting period may be wrong. The current value we think is in large caps, unlisted equities because they don't react to the market, or small caps on a 10 to 20% kind of correction from here on. Gold remains a hedge because overvaluation is there, inflation is high. So a little bit of investment in gold is important. I did cover internationally because I did think that US will continue to rally in this year, and therefore I think global diversification is important, maybe through ETFs, maybe through portfolios, through the stockbroking entities in both the large cap ETFs, S&P, and maybe the small cap ETF in US. At some point of time, China will also have this follow-up rally. So I would think some exposure to China is important. And while India, we see a good decade ahead, fiscal consolidation and fiscal spending, populism, etc., may pull down India. Good way of investing is portfolio protection-based strategies, where you try to protect the capital on the downside and participate in the upside through option methods. Debt today is giving you 7 to 8, but there are enough opportunities in the market giving you 11 to 15%, and some even giving you 20% in AIFs or bonds. And it's a short market cycle environment, so regular portfolio balancing on up moves is important since cycles are shorter. So suppose the market comes down 20 and then rallies 40 at some point of time, then portfolio rebalancing becomes more important. That is the broad kind of stance that I thought I would present in this brief presentation. Saurabh, I think, will put a lot of fundamentals behind these views and give a structured kind of guidance to your to the overall presentation. I would like to hand it over to Saurabh at this point of time.
Thanks, Nitin. I think those were very simplified sort of thoughts and extremely intuitive the way markets have been behaving. What I'll do is over the next 15 odd minutes, take you through the outlook that we have sort of formally rolled out for our investors, and that's what we think the markets could behave or sort of deliver over the next one odd year. So, so as the as the header suggests, and like what even Nitin was alluding to, we do expect that we are coming off from a very fabulous last, you could say, 2 years in terms of returns that Indian equities have generated. And within that, there have been various segments. It could be small and mid caps, which have outperformed, maybe large caps, not as much. But if you zoom out a bit, and maybe look beyond the last 2 years, we were just looking at this data a couple of days ago. 2020 calendar year until 2024 calendar year, which is 5 years, Nifty has delivered, almost 95% sort of returns cumulative. So, the monies have sort of doubled over there. If you were to look at the same period and you look at mid and small cap indices, mid caps have generated almost 1.85 times, while the small caps have delivered upwards of 200% returns or 2.2 times sort of returns. So clearly, we've seen broader markets or small and mid cap oriented companies significantly outperform. And while we've had a great last 2 years backed by multiple factors, I think we are looking at this year to be a year of transition on various counts. Maybe I'll touch base upon that as we progress through the presentation. But in summary, we believe that the market probably will consolidate or deliver at best sort of low double-digit returns from where we are today. So what do you do as an investor? We believe that this is the time, and as Nitin mentioned in his last slide, that we need to rebalance portfolios, and they should be rebalanced towards
Saurabh, sorry,
options.
have you moved your presentation? Because we
No, I'm
can.
not.
Okay,
I'm
all
not.
right. Yeah.
So, so what we do is we try and power up your portfolios by the uh, use of fixed income, high yielding products or alternatives. That's where we'll try to strike the balance. So moving on, while this is the flow of the presentation, quickly, if I were to take you through maybe how the last few months or years were, you'll clearly see that emerging markets have sort of underperformed the developed world in 2024. Uh, S&P 500, only the second time in history, in the near history, after 97, 98, has delivered a back-to-back 25% plus sort of calendar year return and has done better than most of the other leading world markets. Uh, Maybe what has matched S&P 500 returns is the Indian small and mid cap indices. Brent crude broadly has been in that 70 to 75, 77 sort of range through the last year. Gold has delivered a phenomenal 26, 27%. Dollar in the last 1.5 month has appreciated significantly. 10-year yields, if you look at the last section, you'll realize that the 10-year yields have come off quite substantially. And that's because we clearly believe that, and as the markets do believe, that we've hit a peak in the interest rate cycle, and from here we should expect yields to come off. Now, within Indian equities, probably if you look at the way we were to dissect the market, you will see that certain sectors like IT, capital goods, and real estate, they were amongst the top performers, having delivered closer to 30 or upwards of 30% sort of returns. Uh, and the ones which have not done really too well in this last 1 year is private banks as a sector, even FMCG as a sector. And a lot of this, in terms of communication, commentary from different business leaders in this space or in these sectors, does come out quite starkly and reflects that the overall earnings environment, demand environment in the economy is seeing some sort of a slowdown. Globally, while a lot of people really associate with global investments with the US, what it also does have repercussions on is how currencies move and how global yields move. Uh, what we really saw during the last year was Fed eventually sort of pivoting towards cutting rates. But what really dampened the entire excitement was the fact that instead of a 400 basis cumulative rate cut that the Fed was expected to deliver over the last quarter of 2024 and this year, probably all of that has come down to just about 200 basis points, which means that there is going to be uh, a slower sort of rate cut cycle that we see and a much shallower rate cut. And that's the reason why we've seen the US 10-year yields move higher. These are December numbers. If you look at it over the last couple of days, the US 10-year has moved closer to 4.8%. The European 10-year has hence moved, and even the Japanese 10-year is now quoting at around 1.25. So clearly, while rate cuts have been initiated in both US and Europe, the rates on their benchmark yields do not suggest that investors are really comfortable with the commentary that's coming out. And hence, we do believe that this will have implications on global yields, currencies, what global policymakers do. For example, RBI, they still are not taking that plunge and deciding to cut rates. So there seems to be a message from all of this for yields and for global investors. Essentially, maybe what investors are saying is that they need to be rewarded a lot more as far as the US markets are concerned on the debt side, because they do expect that the inflation will remain fairly sticky. While it's come off to around 2.2 odd percent, but they don't really see that falling substantially from here. So if you were to look at inflation expectations in the US, that is what is translating into slightly higher benchmark sort of rates in the US. Another point in terms of what are the cash levels that one's really seeing in the US markets, and how has that been deployed over the coming months or years, even when there has been a similar rate cut cycle in the last many years. So this is data since 2001. So over the last 25 years, you will see that whenever Fed has initiated a rate cut cycle, at the time of initiation of the cycle, there's been anywhere between 500 billion to upwards of 1.2, 1.3 trillion dollars worth of cash or money market or short-term investments that are there, in terms of assets in the economy. And they've made way into various other asset classes because as rates come off, these assets will not really make meaningful returns. And if history were to suggest, these assets will sort of find a new home. So now whether they go back to equities or whether they go back to higher yielding debt assets or they come to emerging markets or emerging market equities, that is something which we will have to wait and see. I think the world is waiting, and they're waiting primarily for one or two reasons. The first reason which we believe that the world is waiting for is Trump administration coming to power, which happens next week, and then the sort of policy decisions that the government gives. There's been a lot of chatter around increasing tariffs on goods which are traded with the US, and much higher tariff rates. So time will tell what sort of tariffs get imposed eventually, how much of that is directed towards China or rest of the countries, how much comes towards India. And I think that's one factor which is keeping most of the investors guessing. And that's where there's a lot more buying happening back into the US markets or in dollars or in any other safe haven assets. But once we see that stabilizing over the next maybe 2 quarters or so, probably we will see money flowing back into emerging market equities. So you could say that this is a tale of two halves in our view. Within emerging markets, then which countries could be the ones which probably could see flows? I think these two charts are quite hard hitting. If you look at the right chart, let me sort of draw your attention to that. What it says is that compared to emerging markets and maybe some of the specific countries within the global equities which are of importance, you will see that over the last 15 odd years, this is September 2009 to September 2024, in respective local currencies, India or Indian corporate has delivered almost 300% cumulative earnings growth or returns, right, on earnings. If you were to compare to that, maybe China onshore or offshore is at around 50 to 100%. Emerging market as a pack is at 36%. Even Korea, Taiwan are much lower than where India stands today. India perhaps is the best possible market. So that's one reason why we do believe that India will start getting flows, despite the fact that we've seen towards the fag end of 2024 FIIs going out from India or turning negative on Indian equities. And the other aspect, more from a macro standpoint, which we believe will help Indian equities or Indian allocation, is on three counts. One is India as an economy does have a very large and a meaningful private sector. So it's not a government controlled sort of an economy or the corporate world, essentially. Secondly, this is we as a country do have shown tremendous growth in earnings per share, which is what I sort of expanded on the right hand side. And we have a reasonable say now in global trade. I mean, in terms of our exports, they've been growing at a reasonable um, growth rate. So clearly, apart from India, there's Indonesia, Taiwan, Mexico, and Vietnam, which sort of ticks all the three boxes. And if this were to be called a Venn diagram of sorts, you will realize that India, apart from these countries, does have all the three combinations sort of working for it. And again, India is a lot more inward-looking economy in terms of consumption-driven, services-driven, not too much reliance on exports or what happens globally. And I think that's where India has an edge. Uh, Interesting data point talks about how in global world markets, bull markets have really performed. This is data since 1970. You'll see that there have been 12 bull markets globally, and the median returns that all of these bull markets have generated has been around 100 odd percent, and they've lasted almost 2.5 years, which is 29 months in terms of the median. Now, the current bull market that we're witnessing has been going on for almost 24, 25 months. So the question is whether this will continue or does it sort of try and align itself to the long-term medians. We do believe that we will hit a pause from here. People will take a stock of how things are, what are the developments that are happening globally, and perhaps after that we'll see some sort of reallocations. Coming to Indian macro, this is a very interesting slide. It talks about some of the high frequency indicators or data points that give us the pulse of the economy in its true sense on a monthly basis. And you will realize that we're seeing some amount of slowdown or sluggishness across the economy. And it's not a surprise given that we've seen full year GDP estimates for this year getting revised lower to around 6.5 odd percent. And we can see that across passenger vehicle sales, consumption. We're seeing that across GST collections. So while GST number is looking, great in sort of isolation, but the overall, momentum has sort of slowed down. GDP again, we all have been, I'm sure, been reading and hearing about it that we've hit a 7-month low in the September quarter ending GDP numbers that the government published. What we are seeing over here, though, is that the consumption revival that one is talking about is coming more from rural, not as much from the urban part of the economy. And maybe that is the sector which will start picking up first and probably followed by, the urban economy sort of picking up. This sort of highlights that in detail a little more further. Now coming to equity markets, if you look at the top right chart, you will realize that this captures the last 5-year flows as far as Indian equities are concerned, bifurcated between FIIs, mutual funds, and DIIs. You will see that 2024, this number is updated for November end. December, we saw some buying coming in. And hence, overall, on a 2024 basis, we've seen marginal positive sort of allocation from FIIs to India. But if I were to compare that with the previous two years, you will see that FIIs in 2023 allocated almost $20.7 billion, while they pulled out money in 22, 21 was again a positive. But the only thing that stands out over here is that every single year, it's mutual funds and DIIs which have been consistently adding towards Indian equity. So that's become a very formidable counterbalance to what the foreigners do. To give you a little bit of a interesting data point, we all are aware about PPFs, PPF accounts, EPFOs, NPS, various government schemes, small saving schemes, etc. All of these put together, given their allocation towards equities, have been allocating anywhere between 35 to 40 billion towards Indian equities every single year. So that itself has now created a very strong sort of continuous buying that comes into Indian equities from institutions. Apart from that, SIP numbers, the bottom left chart you will see, has already crossed 25,000 crores on a monthly basis. If you look at where we were in in Jan of 22, which is not too far away. That's just like 3 years away. We were at almost 11,000 odd in terms of monthly SIP numbers. That's sort of doubled now in the last 3 years, which is again sticky money coming in, and I think that again is ensuring that we have a certain floor created for the markets. This gives us a sense of again how foreigners versus the domestic investors have pumped in money into Indian equities on a cumulative basis. So if you look at the right hand chart, there's a clear divergence from December 21, or you could say Jan of 2022 onwards till now. And DIIs have been single-handedly sort of supporting or pulling back the markets, while FIIs have been fairly tentative. And if you also look at the left-hand chart, this was actually from the September peak that the markets hit. From there until when this data was prepared, you will see that there was almost 14 billion worth of outflow in that 1.5, 2 months time. And markets sort of corrected only 10 odd percent. Had this been a case in maybe say 10 years ago or 5 years ago, the drop in markets would have been far more sharper, like how we saw during the COVID fall before it sort of bounced back. Various ways to measure a market, whether it's expensive or cheap. On a market cap to GDP, we are obviously above average. On a forward price to earning basis, we're trading at almost 21 times, 20.5 to 21 times, while the average is at somewhere around 19 times. So we're expensive by that logic. Price to book, if you look at debt versus equity or bond yields versus earnings yield, there again, it's showing that bonds are a lot more attractive. Uh, data point which I think grabbed our attention, some analysis done by Goldman. What it shows is how MSCI India, has in terms of its correlation with earnings, as well as what's the current or forward P that you're currently trading at on the index, really deliver returns from a next 3-6 month perspective. So we're today at around the 20 plus mark in terms of 1 year forward earnings. And if you look at this data, which is aggregated since 2003, so a lot of credibility, multiple cycles that this data has seen. And mind you, we are seeing earnings downgrade cycle. We are not seeing earnings getting upgraded, and probably that will continue for the next 1 or 2 quarters. When you have a combination of earnings getting downgraded and PE being expensive or higher than average, your next sort of 3 months, 6 months returns are barely flattish. I mean, over 6 months, market's been flat. Over 3 months also, it's delivered barely 2% returns. So clearly, we are, like Nitin said, in a space where we are going to consolidate. We might not see sharp corrections, because every time market corrects 2-3%, we see money coming in because there's so much of liquidity that's available. But what we need to do is try and utilize this time in the market to really create portfolios which are a lot more quality oriented, where there is clear visibility of earnings. And we look at working with managers or PMS managers or AIF managers or mutual fund managers, whom we term as alpha managers, which essentially mean that they'll be able to generate a meaningful alpha in portfolios vis-a-vis indices or the larger peer set, basis their stock picking skills, their sectoral allocations, etc. So that's the period. So to put it very simply, this is very similar to what we saw in 2021, mid to almost the end of 2022. So that 18-month period, market Nifty really didn't move much. It was in that 1,000-1,500 point range. I think that's something which we will witness going forward. This is just another way to look at the same data point. So that brings us to the outlook on equities. So what we're saying is that we are sort of cautiously optimistic on the markets. We do believe that Nifty will remain range bound. If we were to discount December 2025, where will the markets will be? We'll discount it for 1 year forward earnings. We do believe that on a base case basis, we should be somewhere at around 25,000 to 25,500. So which is around broadly 2,000 points from where we are today, which means that talks about on a base of 23,200, that's about 8 to 10% sort of returns on a base case that we see Nifty delivering this year. You might have a few managers or certain pockets in the market that will deliver slightly better. If some of the risks were to play out, which maybe I'll highlight in the next slide, you could see the markets going down to around where we are currently, or maybe on a technical basis, closer to 22,500 at best. But we don't really see markets falling off the cliff from there. And on the upside, we don't see it really breaching 27,500 meaningfully. The reason for this is that there's a lot of alteration that's happening or change that is happening in the way money is coming into India. So if you look at this point, we've mentioned that while there's a lot of money that is changing hands in the secondary market, but there's a lot of FII participation that is also happening in the primary market. So I think that is one space, new businesses, which I think a lot of investors or institutional investors are trying to orient themselves towards. And I think, or in our view, that's the opportunity that this market represents. So while structurally we don't have a debate about where India is going and how it's going to be amongst the best performing economies, the fastest growing, and which you can't ignore really from a market perspective. But the near-term adjustments or the flux that we see, which is a lot more global driven, will have its implications on how Indian markets behave. And I think till that point in time, we don't get clarity. We might just get some sort of sideways market movement. Uh, Coming now to maybe some of the risks. Uh, I think Trump government policy decision is one of the key risks. Shallow rate cut is another. We are also seeing geopolitical developments, etc., which could have concerns on the market, and a corollary to that is pressure on currency, and of course, valuations being rich. Fixed income, it's a very short sort of a two-slider. What we're saying is that we still do believe at 675, 680, 10-year or GSEC becomes a very interesting proposition. So maybe around 40-50% of the portfolio could go towards that, assuming we could see a 50 to 75 basis rally over the next 18 months. And that could mean delivering anywhere between 9 to 11% sort of returns on a pure play sovereign bond fund portfolio. But then there is ample opportunity available in the high yielding space, because as a credit environment is, credit as an environment is quite comfortable the way we see it. And basis that we do believe that if we do tie up with the right set of managers where credit underwriting is something which we'll have a lot of comfort on. I think delivering closer to 15, 16, 18% returns in that space is also not too difficult. So a mix of this is what we propose on the fixed income side. I'll maybe cover a few ideas. We do believe that China still provides an opportunity. We gave a call, and after that, the call's not yet worked out in the last 3-4 months. But we do believe that that's again an opportunity, given that China is really coming off a very low base and much cheaper in terms of valuations relatively. The only sort of point over here which could still keep people guessing is what does Trump do in terms of the tariffs that they will impose. So maybe that's something which could be a wait and watch. One interesting category which is really coming up in the market is the multi-asset allocation fund category. One is taxation changes has resulted in fund managers coming out with differentiated product ideas to ensure that your investments also generate a very um, uh, tax efficient sort of return as much as possible. So while there are a lot of multi-asset allocation funds today which invest at least a minimum of 65% in equities, but they tend to be quite a lot volatile compared to what one would expect when one is in a multi-asset allocation fund. I think what White Oak does is beautifully try and capture the space between 35 to 65% sort of equity, which means that post a 2-year holding, the investor benefits 12.5% taxation on LTCG. And at the same time, they do take exposure even towards gold and silver. And this is perhaps the only fund which does silver arbitrage in its portfolio. And to give you some example, in the last 3 months, from September 26, 27, when we hit the market peak, and we saw a 10% drawdown, market picked up by 6% in November, December, and then it's again sold off by almost 6-7%. In this entire 90 to 100-day period, probably compared to a lot of other multi-asset allocation funds, I think White Oak has delivered almost a 6% absolute alpha in this time period. So I think a very interesting strategy for investors who do want to differentiate their portfolios and include something which is not a plain vanilla balanced advantage sort of fund which has been there for the last 15 odd years. We do have few multi-cap and small cap PMS ideas. Like I said, we do believe in dealing with managers who can deliver alpha. Healthcare PMS, for example, has delivered upwards of 70% returns in the last 1 year. It's one of the few strategies on the healthcare side which has really stood out in terms of the portfolio construct. versus a lot of other PMS mutual fund strategies on healthcare space, which are a lot more benchmark hugging. So I think with a very concentrated portfolio, the manager has been able to deliver that returns. If you need to know more about this, I'm sure your relationship managers can help you. And then we have Aditya Sood, who is also a senior fund manager with us, and we like his stock picks predominantly. I think that's been his forte ever since he's been with us and through his career, where he started with ICICI Prudential, etc. So I think some of these ideas do make immense sense. Maybe that's what I wanted to cover on the presentation in terms of formal view and maybe some ideas we have.